Okay, welcome back. 15 minutes to go for the pre-open session. The big story from the Reserve Bank of India, of course, is RBI's draft norms on liquidity coverage ratio. Now, these are draft rules, but they say that banks will have to assign additional risk weight for internet and mobile banking-based deposits. What does this mean for banks, and is this negative to what degree? We have Rikin Shah, Vice President at IIFL Securities, joining in now. Rikin, good morning. Good to have you with us here. Thanks for your time. What do you make of it? I mean, first of all, what percentage of accounts would be sort of internet enabled in that sense, digital enabled? And what does it do to sort of LCR for the banking sector, if you've sort of done any numbers?
Sure. Good morning, Prashant, and thanks for having me. Before I get into the numbers and the impact, the genesis of RBI doing this, last year we saw SVB in the US seeing a big deposit run. $40 billion plus deposits were moved out in a single day. And given the increasing nature of digital transactions, the deposit runs for the banks during the stress periods can be much faster. And hence, to improve the liquidity profile, RBI has tweaked the norms. Now, talking about the specific question which you asked, they have increased the runoff factor for the retail deposits and the deposits kept by small business customers. The runoff rate has been increased by 5 percentage points. Now, when we discuss with the banks, a large proportion of these deposits are held digitally, in the sense that a customer either has access to mobile banking, net banking, or even UPI facility. So any customer who has access to any of these three things will see the runoff factor going up. And in our discussions, we have assumed, after speaking with the banks, we have assumed that around 80% of the total retail deposits would be impacted, given that they are digitally enabled. Whereas for PSU banks, it can be slightly lower. And the retail deposits typically constitute anywhere from 45 to 55% of the total deposits for the bank.
So, can you explain for our viewers, when you say runoff factor would be higher, what do you mean by that?
So basically, in the LCR calculation, there are certain cash and the government securities that you hold, which is included in the numerator. They are considered very liquid, which you can liquidate in the periods of stress and quickly meet the obligations. In the denominator, they look at the stressed cash outflows in the next 30 days. And hence, for instance, if there are certain deposits held by us, a certain haircut is applied to that. So let's say a 5% runoff factor is applied. And if you have 100 rupees of total deposits, retail deposits are 50%. So on 50 rupees of those deposits, 5% of runoff factor was applied earlier. And hence, in your denominator, this 50 into 5%, your 2.5 goes into the denominator as the cash outflow. Now, this runoff factor has moved up from 5 to 10%, and hence the denominator has increased, which is why your LCR goes down, and the regulatory minimum is around 100%. So that answers the first part of your question as to what proportion of this retail deposits are digitally enabled or have digital facilities. The second part of it is how do we quantify the impact for the banks? We have done some sensitivity analysis. First point worth highlighting here is that for the PSU banks, they have been consuming excess liquidity and they've brought down LCR very dramatically by 15 to 20 percentage points in last 2 years. They are still higher than your private banks. Currently, private banks are around 120%, PSU banks are around 130, 35%. That is how things stand today. Among the top 15 banks in India, IndusInd, IDFC First Bank, and Federal Bank have relatively lower LCR compared to the peers, of course, much above the regulatory minimum of 100%. Now, basis this changes in the draft guidelines. We discussed one aspect of it. There are a couple of other technical aspects which I'm not getting into. We estimate that the LCR, pro forma LCR, can go down by anywhere from 10 to 20 percentage point and drive margin compression and earnings impact for the bank. So it's an incremental negative for the banking sector.
How much earnings impact, Rikin? I mean, roughly, in what range?
So the LCR hit is, as I quantified, 10 to 20 percentage point. So many banks will go closer to 105, 110%. Banks like Federal Bank may see their LCR fall below the regulatory minimum of 100%. So that's on the LCR front. On the PNL impact, given that now to shore up this LCR, you'll deploy more money in your securities which are lower yielding rather than loans, and CD ratio goes down. So there is a negative spread. So the NIM impact of mid-single digit and earnings impact of mid-single digit. While for PSU banks, the LCR is still going to be comfortable, but the margin impact and the sensitivity is relatively higher in terms of the EPS impact on their P&L.
10 seconds. Most impacted stocks today?
Federal Bank can see a bigger hit because the starting point of LCR is relatively lower. Even IDFC First Bank has relatively lower LCR. So among the top 15 banks, just basis the sensitivity analysis, these are the stocks who could see more impact. But it's generally the entire banking sector which gets negatively impacted, and we'll have to wait what the bank representations to the RBI are and consequent final guidelines. These are still draft
Absolutely.
guidelines at the moment.
Yeah, no, absolutely. We don't know if they'll give any offset, but we, at this stage, right? But these are draft regulations, but markets will treat this, as you said, more negative, and of course, more negative for some as compared to others. You mentioned two, Federal Bank and IDFC First. Rikin, a quick conversation this morning, but we'll sort of pick up on this in some detail with you later. Thank you for joining us.